Welcome to today's Explainer. So you definitely know Sugar Cosmetics founder Vineeta Singh. She's a beloved judge on Shark Tank India, and millions of people literally take her business advice as gospel. But today, well, we're flipping the script. How do the companies owned by the sharks actually perform when you strip away the TV magic? Using purely audited financials, we're deconstructing Sugar Cosmetics.
135 crore rupees. Yep, you heard that right. Despite being led by top-tier IIM Ahmedabad experts, Sugar Cosmetics is absolutely burning through cash. In fact, their losses practically doubled from the previous year, jumping from 68 crore to a staggering 135 crore rupees. To put that in perspective, for every 100 rupees they earn right now, they're burning 135. It is a huge, shocking paradox.
Okay, let's dive into this. We really need to understand exactly what's happening under the hood here. I mean, why is a company this prominent with a founder who expertly diagnoses other people's business flaws on national television struggling so hard to find profitability after more than a decade in the game?
Section 1. Sugar's Recipe for Success.
Launched back in 2015, Sugar found this absolutely brilliant masstige positioning. We're talking premium makeup formulated specifically for Indian skin tones, but priced smartly between 250 and 1,200 rupees. This created a beautiful multi-year growth trajectory. They leaped from 126 crore in FY21 all the way up to 505 crore by FY24. How? Well, they nailed a pioneering nano-influencer strategy, expanded aggressively into Tier 2 and Tier 3 cities, and got an estimated 100 crore rupees in free primetime PR just by Vineeta being on Shark Tank.
But as we moved into financial year 2025, the picture completely changed. For the first time in a decade, top-line revenue actually fell, dropping 20% down to 412 crore. And meanwhile, bottom-line losses just skyrocketed, doubling to that 135 crore figure we talked about. Look, when your revenue falls and your losses double at the exact same time, your core engine is seriously sputtering.
And you know, this financial strain doesn't just happen in a vacuum. It's had very real-world consequences. Back at their peak in 2022, Sugar was flying high. Investors were pumping in $50 million at a $500 million valuation. Fast forward to today, that valuation has dropped by roughly 35 to 40%, now sitting somewhere between $300 and $320 million. Plus, between July 2024 and July 2025, the company very quietly reduced its workforce. They let go of about 32% of their staff, dropping from 660 employees down to just 450, and they did it without any major public announcements.
Section 2. The 135 crore leak, unit economics.
So how exactly do you lose 135 crore in a single year selling cosmetics? Well, the biggest leak in the bucket by far is advertising spend. Take legacy beauty giants like Hindustan Unilever or L'Oreal. They typically spend about 8 to 15% of their revenue on marketing. Sugar Cosmetics, on the other hand, spent a massive 168 crore rupees on ads in FY25. That means a whopping 41% of their revenue is going purely toward digital ads. They are heavily relying on paid marketing, even while their actual revenue is falling. So the crucial point here is understanding the dynamic between CAC, which is customer acquisition cost, and retention rate. CAC is simply the amount of money you have to spend on ads to convince one new customer to buy your product. Retention rate is the percentage of those folks who actually come back to buy from you again. Now, on TV, Vineeta rightly advises founders that a healthy retention rate should be at least 35 to 40%. But the hard data shows Sugar's own retention rate is currently hovering at just 20 to 25%.
And honestly, this brilliantly illustrates their fatal math flaw. Imagine this. Sugar spends roughly 1,000 rupees on ads to get a customer to click over to their website. If that customer then buys a 400 rupee lipstick, Sugar has instantly lost 600 rupees on that transaction. That model only works if the customer keeps coming back. But because their retention rate is only 25%, 75 out of 100 customers buy exactly once and then they vanish. Meaning Sugar has to constantly burn another 1,000 rupees just to find the next person.
Section 3. 3 major growth roadblocks.
Now, this broken math isn't their only headache. These recent struggles are being heavily compounded by 3 massive operational roadblocks hitting the company all at once. We've got the offline expansion trap, a really vicious advertising loop, and a highly unfortunate warehouse fire. Let's walk through exactly how each of these is draining their capital.
First up is the offline trap. Because 85% of India's beauty market is offline, Sugar absolutely had to move beyond the internet, so they aggressively expanded to over 500 offline touchpoints. But here's the catch. Traditional retail is a completely different, extremely harsh game. When you sell a 100 rupee lipstick in a physical store, roughly 35 to 40 rupees immediately goes to middlemen. Distributors, retailers, logistics, they all take a cut. What's worse, those distributors take 3 to 5 months to actually pay the company. So Sugar is manufacturing today, delivering today, but waiting nearly half a year just to get paid, all while surviving on razor-thin margins.
Roadblock 2 is the digital advertising loop. Over the last 3 years, the cost to advertise on platforms like Meta and Google has spiked by 40 to 60%. A reel that used to cost 10 rupees to reach 1,000 people, it now costs up to 18 rupees. It creates this terrifying, vicious trap. If Sugar stops running these super expensive ads, their revenue instantly plummets. If revenue plummets, investors panic and their valuation drops even further. But if they keep running those ads at these inflated rates, it completely destroys their profitability.
And why exactly are ad costs so incredibly high? Because the market is just insanely crowded right now. There are over 3,300 competing D2C brands fighting for the exact same consumer. In Sugar's sweet spot, that 250 to 1,200 rupee range, the competition is absolutely fierce. You've got My Glam pushing hard, Mama Earth expanding from skincare into makeup, brands like Renee and Plum, and crucially Nykaa. Now, Nykaa is the very platform where Sugar sells a lot of its products, but Nykaa currently has 27 of its own in-house beauty brands. Naturally, it makes a lot more financial sense for Nykaa to promote its own stuff over Sugar's.
And then, roadblock 3. Just terrible, terrible timing. In November 2024, a massive fire broke out at one of Sugar's warehouses, completely destroying roughly 20% of their inventory. And the timing? Literally couldn't have been worse. It happened right in the middle of India's festival and wedding season, which is the absolute peak demand period for the entire beauty industry. Estimates suggest this single event cost them somewhere between 30 and 50 crore rupees in missed revenue.
Section 4. The profitable competitor proof.
Now, what's really interesting about all this is that it's super easy to blame high ad costs and fierce competition. But losing money is not a mandatory rule in the Indian D2C beauty space. Just look at Mars Cosmetics. Sugar is heavily funded, doing 412 crore in revenue, but sitting on a 135 crore loss. Mars Cosmetics, on the other hand, is entirely bootstrapped, not a single rupee of investor funding. Yet, they generated 200 crore in revenue while maintaining an 8 to 10% EBITDA profit, completely avoiding that unhealthy growth-at-all-costs mindset.
Honestly, it all comes down to a very simple business reality. Think about your neighborhood kachori shop. If they sell you a delicious kachori for 10 rupees, their actual profit isn't 10 rupees, right? Just because a startup has 500 crore in revenue doesn't mean they earn 500 crore. Revenue is just the top line. Profitability is the bottom line. Selling a massive volume of goods means absolutely nothing if the underlying unit economics of making and selling that item just aren't profitable.
Section 5. Can Sugar actually recover? So, to be completely fair and objective here, can Sugar actually dig themselves out of this hole? Well, management certainly believes so. They are projecting 520 crore in revenue by FY26 and operational break-even by FY27. However, I should note that independent analysts haven't exactly backed these ambitious projections yet. Aiming for 26% growth right after a 20% decline is a huge ask, and their IPO plans seem to be quietly delayed past 2027.
But let's be crystal clear, recovery is absolutely possible. The Indian beauty market is absolutely booming, expected to hit up to $48 billion by 2030. Plus, Sugar still has incredible brand visibility, a really strong community, and a massive offline distribution network. But to survive and thrive, they have to fundamentally change how they operate. They must drastically fix their customer retention, getting that repeat rate way up from 20%. And they have to stop the bleeding on their marketing burn. The focus literally has to shift from buying revenue with expensive ads to building a sustainable, returning customer base.
So I want to hear from you. Looking at all these verified numbers and the reality behind the valuations, do you think Sugar Cosmetics can actually fix its unit economics and bounce back? Let me know your thoughts down in the comments. Also, tell me, which shark's business should we decode using the data in our next explainer? If you found this breakdown valuable, please hit that like button, share this explainer with someone who loves business as much as we do, and make sure to subscribe for more completely data-driven insights. Thanks so much for watching and keep learning.